Thank you, and thank you, all of you great supporters out there. Without you guys, the channel will not be where it is today. Thank you for all your heartwarming comments, and I hope that you are growing your wealth smoothly with all the contents that I have shared. If you have any burning questions to ask, do drop a comment below, and also remember to smash the like button, subscribe, and turn on your notifications for updates on new videos released. We have also received numerous feedbacks and good questions from all of you curious, intelligent value investors out there. This video is here to share my answers to these important and frequently asked questions about value investing and IV calculation. So first, let us recap what this strategy is all about. There are thousands and thousands of companies in the US market. How do we decide which are the good ones to do long-term investing in? This strategy filter out the top 1% of these companies, and for this, we're asking for three things from our companies. The first two being fundamental strength, which is determined by these steps, and growth, measured by these steps. Once a company is proven to be strong and have the growth potential, only then do we look at its value. And there is a reason why I do things from step 1 to 7 and not the other way around. That is because for step 6, which is the calculation of the intrinsic value itself, it builds on and relies a lot on our first two steps. In particular, the cash flow from operations and the growth rate. The modified discounted cash flow model that we use in step 6 assumes that the operating cash flow will grow continuously by the stipulated growth rate for the next 10 years. And it is on this basis that we arrive the bulk of our IV. On top of this, the main reason is also because of the equation that we use. To calculate the IV of a company, we are taking the ops cash flow and multiplying by its growth rate for the first year, the square of the growth rate for the second year, the cube of the growth rate for the third year, and so on and so forth. Can you see that we are projecting the value of the company based on how much it brings in and grow? This projection is exponential. Now in this equation, the discount rate is being applied exponentially as well. But in actual fact, the impact of the discount rate on the IV is not as great as the ops cash flow and the growth rate. Therefore, in order for our calculated IV to be as accurate and reliable as possible, we want to make sure that the company does indeed have the capability to grow continuously. And to prove this capability, we want to see that its step 1 has been growing consistently for the past 5 years. When you see that a company has in fact been growing consistently for the past 5 years, does it give you a greater confidence that it can continue to grow like this for the next 10 years? And if so, will your calculated IV have a greater reliability and credibility? On the other hand, if you see this kind of trend and still goes ahead to apply the IV calculation on them, then you are just simply asking for trouble. If the profitability of the company is in the negative or declining for the past 5 years, and yet you calculate its value based on the assumption that it will grow by a certain percent for the next 10 years, does it simply make sense at all? So simply put, the modified discounted cash flow model is a rubbish in, rubbish out method. It is up to the user to make sure that the numbers you input make sense. If you apply this strategy to some lousy company, the likely result you will get is that the company is undervalued. But once again, does this all make sense? And with this train of thought, I will also avoid newly IPO'd companies or new companies as well, until they have shown their track record. In fact, if a company doesn't show satisfactory result for these first 5 steps, I will not even bother with its value. As an value investor, I only want the best of the best in the market. So I hope by now you have understood why I go from step 1 to 7 and not the other way around. And also the importance of fundamental strength and growth coming first before the value. Next, the calculation of the intrinsic value itself is also another hot area where I've received numerous questions on. I understood that some of you may have a finance background or an accounting degree. And with your in-depth understanding in the field, you may ask questions like, why do we use ops cash flow in the model and not free cash flow? Why do we use a raw discount rate instead of something more precise, like the weighted average cost of capital? These modifications will result in the model being more reliable and credible, but at the same time comes the cost of convenience and ease. The model that I share aims to balance simplicity and accuracy, so that all laymen out there without a financial background can do the analysis by themselves without much hassle. If you have the capability to modify and tweak the model to be more reliable to suit your needs, please do so by all means. And also please be consistent in your analysis. For example, if we change the ops cash flow to free cash flow, which is a more stringent parameter, no doubt that the IV you get would net you a greater margin of safety. Another concept that we will talk about later in this video. But how can we get the free cash flow? You can calculate it by taking the ops cash flow and then subtracting it by a series of other financial figures. The more important one being the capital expenditure or capex. And with this, you arrive at the free cash flow figure. Do you see how much more complicated the calculation becomes? The same thing goes for using the weighted average cost of capital as a measure of our discount rate, which is the WACC. Yes, it will give us a more stringent IV, but look at how tedious arriving at the WACC is. It is almost the effort of another intrinsic value calculation by itself. So once again, there is nothing wrong with substituting in more accurate figures to get a better model. In fact, if you have any ways of getting these numbers or any other substitutions with ease, please share your approach with us in the comments below. With that, the next area of the IV calculation that I want to focus is on the growth rate. This is another problematic area because we have to rely on analyst estimates. If there are no analysts analyzing the company, we have no growth rate. If the analyst from different websites uses different models to compute the growth rates, we may have widely differing growth rates. And if so, what do we do? First, let us review again what are our available sources for the growth rates of companies. My first favorite and go-to source would be Finviz. So under finviz.com, you can just key in the ticker symbol, and if you scroll down slightly, the growth rate can be identified from EPS next 5 years, and under Finviz, it reports Visa projected growth rate of 10.35%. So this is the first source. An alternative source would be Zacks.com. Just key in your ticker symbol, go over to detailed estimates. And you can find the reported growth rate for Visa for the next 5 years to be at 12.6% from the Zacks analyst. You can see that it differs slightly from Finviz. The third source of information that I like to use is Simply Wall Street. For this website, you will have to create an account. And once again, just key in the ticker symbol of the stock that you would like to look up on, and then go under their fourth section, Future Growth. If we click to fast forward to that section, you can see that they likewise have their own model of projecting the growth rate, and they arrive at a forecasted annual earnings growth of 13.4%. Now, for Simply Wall Street, take note that their growth rate is projected for the next 3 years, instead of the next 5 years that we are so familiar with from the other websites. If you rely on the estimates from Simply Wall Street to do your intrinsic value calculation, there might be a need to tweak some of your figures in the calculation itself. And last but not least, Yahoo Finance is also another reliable source that you can look up the growth rates of companies on. Likewise, key in the ticker symbol and then go over to the section on analysis. Scroll down all the way till you reach the growth estimate section. And the figure that we are interested at could be found under next 5 years per annum. Similarly, Yahoo Finance reports it to be at 10.35%. For the example of Visa, can you see that the growth rates from differing sources differs, but in this case, not too widely. And for such cases, I may choose to go for the more conservative approach and take the lowest growth rate. But if they differ too much, I may choose to take the average of all these sources instead. Once again, this is up to your personal judgment and preference. The links to these websites can be found in the description below. And there should be more sources like these out there in the internet. So if you have any other sources where you derive your growth rate from, please share them with us in the comments below. Of these 4 websites that I've shared with you guys, the first 2 websites are more for US companies. If you are interested in companies from other countries, you may have better luck relying on Yahoo Finance or Simply Wall Street. When calculating the IV of companies from other countries, take note to do the necessary currency conversion. For example, Alibaba or JD.com. Morningstars report their financial statements in Chinese yuan. And with that, the IV that we have calculated for Alibaba will also be in Chinese yuan. But these stocks trade in the US market in USD. So do search up the conversion rate and do a rough calculation. As a reminder, you may also want to take note of the units as well. as sometimes Morningstar reports in billions and sometimes in millions. So make sure to keep these units consistent. Finally, after going through so much, we get to the intrinsic value of the stock that we are interested in. But have you questioned yourself? What does this intrinsic value mean? The IV that we have calculated is a means for us to get an estimate and get as close to the real value of the company as possible. What is the real exact value of a company? It is very hard to say. So this value is often unknown and a mystery. That's the purpose of calculating the IV. When calculating the IV, we want to be as conservative and stringent as possible so that our estimated IV lands at or below the real value of the company, creating value for us. And because I tend to be overly conservative at times, I allow a 25% buffer on top of my calculated IV. That is to say, as long as the current price of the stock land anywhere between this mark and the IV, I will consider the stock to be at fair value. Anything below the IV, it means that the stock is currently undervalued. This 25% buffer that I've introduced have brought about a lot of confusion amongst you guys. And that is why I feel it is important that you guys fully understand what it is about. This buffer range that I set is purely based on personal preference. If you're uncomfortable with this buffer, you may choose to remove it totally, especially if you feel that you are being generous in the calculation of the IV. But once again, please be consistent throughout all your analysis. If you decide to set the 25% buffer range, please stick to it always. And if you choose to remove it, then do not bring it back in just to satisfy certain exceptions for the companies that you like. The next confusion is this 25% buffer that I allow the margin of safety? The short answer is no. First of all, what is the margin of safety? The margin of safety is created when you purchase something for below its value, therefore minimizing the potential of further downside. In this example of ours, there is two different margin of safety to be exact. The first margin of safety is created when we choose to be stringent and conservative when setting our IV. Since the real value of the company is not known, there is very little meaning to discuss about this margin of safety, as it will be an unknown as well. So the next margin of safety that we can meaningfully calculate is the difference between the current price and the IV. For example, the IV of Visa is at $93. And let's say we manage to buy it at $50. If so, we have invested in Visa with a rather wide margin of safety of about $43. And because Visa has already fallen so much from its IV, we have heavily minimized our further downside. At most, there is another $50 for Visa to drop and then goes bankrupt. But will that really happen if you have done your homework from step 1 to 5 to ensure that the company is fundamentally strong? So by now, I hope that it's clear to you why the 25% buffer that I allow is not the margin of safety. If anything, in fact, including the 25% buffer will ruin the margin of safety for us. Let's say now Visa is currently at $100. Now because of my 25% buffer, I will treat Visa at 100 to be at fair value and will be willing to purchase it. But my investment at $100 will have no margin of safety at all because it is above our intrinsic value of $93. Okay, so once again, this 25% buffer is not the margin of safety. If this is the first time you are doing the analysis yourself and get some ridiculous IV value for a company, do not panic and doubt yourself yet. Let's take the trade desk for example. If you have analyzed this stock yourself, you should get an IV of about $60. But the stock is currently going at an insane $400. Is your calculated IV wrong? You frantically ask yourself. Calm down and let's double check with another parameter. That is the PEG ratio or PEG ratio for short. It is simply the price divided by the PE ratio of the company. This roughly follows the concept of the model that we use to calculate the intrinsic value, but in a much more simplified way. We can get this value from FinVis under the PEG column. So you can see that for Visa, it has a PEG ratio of about 3.39. So how do we read PEG ratio properly? I'll take any reading of the PEG ratio from 1 to 1.25 as fair value. You can view this 0.25 similarly as the 25% buffer that I allocate to the intrinsic value of the stock. So 1 to 1.25 is considered fair value, and anything below 1 will be considered undervalue. and anything above 1.25 will be considered overvalue. So if you apply this concept to Visa, the PEG ratio is telling you that Visa is currently about 3 times above valuation. Alright, what about the trade desk? From FinViz, the PEG ratio for the trade desk is standing at about 6.33. So can you see that the intrinsic value that we have calculated to be at $60 is actually rather accurate. If based on the IV that we have calculated, the trade desk will be overvalued by about 7 times. And this likewise is reflected in the PEG ratio as well. Alright, the PEG ratio works most of the time, but not all the time. Therefore, you must still have the confidence in your own analysis. Alright, I hope the questions that we have discussed today have led to a better understanding on your part about the whole value investing strategy, and more importantly, how to properly apply the intrinsic value calculation in step 6. There's still a lot more questions to go through, and we will take a look at this in another video. So continue to keep a lookout by subscribing and turning on the bell notification to get news of when the next video will be up. Also, do help me out by smashing the like button. Thank you so much, and I look forward to seeing you again in the next video.